Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm here Dadia. We have with us Professor Aswath Damodaran, Professor of Finance at the Stern Business School at the New York University, joining in. Welcome to the show, Aswath, and a pleasure to speak to you as well. And I'm sure, I think more than anyone knows you as Aswath, it's more like Wall Street's Dean of Valuation. I think that's what people recognize you with. So it's really a pleasure to have you and speak to you. My first question coming to you, Ashwath, is how important, according to you, is valuations in terms of where markets go? Because clearly, over the last couple of years, especially when you talk about the Indian markets, I've never heard someone come out and say that the Indian markets are not expensive right now. It's
Right.
always been a trend that markets are expensive. Whether should we invest? Is this the right time? Is this not the right time? So, how important a matrix is is valuations in terms of when you're looking at the stock markets?
And the valuation is not a debatable issue. The value of a business is a function of its cash flows, growth, and risk. That's always been true. Markets have minds of their own. In fact, when I start my classes on valuation, I start by contrasting the difference between value and price. Now, value, I say, comes from the fundamentals of a business. Price is set by demand and supply. And I think what you might be saying is that right now, what you see as prices in the market are not reflective of value. And that can happen in any market. It's not just India. The one thing, though, I'd caution you is when people tell you that the market is expensive, check out their age. Here's what you're going to see. The older someone is, the more expensive markets look like to them. And here's the reality. When most of these people, even market experts, tell you the market is expensive, they're not basing it on value or valuing stocks. They're basing it on what they think is a normal pricing. Now, there's actually a lot of research in behavioral finance that suggests that what we view as normal in our lives happens between the ages of 30 and 35. So what you see between the ages of 30 and 35 gets cemented in your mind of, hey, that's what's normal. So if you're 65 years old in the Indian market right now, everything looks incredibly expensive. You know why? Because 30 years ago, think of what PE ratios look like in the Indian equity market. It was like 12. So when you look at paying 25 times earnings or paying for companies that don't make money, you're saying, this is crazy. But maybe that's more a reflection of your age and how disconnected you've become with markets than it is of markets themselves. So I think there's a little bit of hubris floating around among experts thinking, I know what's right because I've been around markets a long time. But I'll tell you, investing is one area where experience doesn't bring wisdom. It just brings entrenched views about markets that actually get in the way of wisdom. So no matter what I think about markets, one of the things I've learned is to set it aside and take a fresh look. Look at the market through the eyes of the people who are actually buying stocks rather than viewing them as shallow or not very. I hate the term retail investors because when people use it, you know what they mean, right? Those stupid unwashed masses. What do they know? We're the professional investors. To heck with the professional investors. They don't even know what they're doing. I actually trust the honesty of retail investors because they don't try to hide behind history or behind made up wisdom. So I'm not disagreeing with the fact that we're paying higher prices for stocks now than ever before. But before I view that as crazy or overpriced, I want to look at potential reasons.
Right. So, with this, if you have to look at the Indian markets right now, we're touching the roof. There was a point in time where, especially from the healthcare front, there was no correlation between where markets were going, whereas what's happening to the economy, what fix we are in on the healthcare front. However, from March 2020 to now, I think we've just kept breaking records over records. What do you make of this kind of a rally that we are seeing right now?
Well, it's not just again unique to India. March 23rd of 2020 was the absolute floor for markets around the world. S&P 500 was down 35% between February 14th and March 23rd. Since March 23rd of 2020, markets around the world have not just recovered, they've recouped all their losses and gone up. But we'd be wrong in thinking that it's been a full-fledged recovery. It's been a shift of wealth from one sector to another. Not all companies have come back. Not all sectors have come back. What you've seen is a reallocation of value from old 20th century manufacturing sectors to more service-oriented software technology businesses. I hate the word intangible, but I'm going to use it, that derive their value from intangible assets. In fact, in the middle of last year, I wrote a post on how this virus might finally have brought us into the 21st century. Because for a long time, people were still holding on to the 20th century, using rules developed from the 20th century to evaluate how you looked at stocks, using metrics from the 20th century to look at stocks. And we were 20 years into the 21st century and people were still refusing to grow up. COVID woke us up. It accelerated trends that had been going on for the previous 10 years, rubbed it in our face and said, wake up, the world has changed, you need to change with it. I think this, COVID has woken us all up to the value of being flexible in our personal lives and business lives. Rigid systems were punished. And you know what? Maybe they should have been punished.
Right. So right now, if someone has to understand whether he or she should invest in the markets or not, again, valuation, as you said, does play an important role. Price to earnings is something what everyone usually uses. What, according to you, is the best matrix to use to understand what's the kind of value that you're looking at right now? Where are you looking to invest?
Well, let's start by looking at, when you invest, you got to think about your alternatives. So if somebody says, should I invest in stocks? My question to them is, what are you invested in right now? If you're invested making 10% on fixed deposits, I'm going to say, okay, stay in fixed deposit. But who makes 10% anymore? You're making 2% or 3%. We've got to live in the world we're in, not the world we wished we were in. I know stocks look expensive, but the question I always ask is relative to what? Where are you going to put your money? Oh, real estate? Try real estate in India. See what you get as your yield on cash flows. Try buying bonds, see what you get. Go into a bank and put your money in fixed deposits. We live in a world where essentially we're measuring what we make on stocks to returns we're making on other asset classes that don't look good. In the US, in fact, I compute, just like we do a P ratio for stocks, I do a P ratio for bonds, which is just the inverse of the T-bond rate. Right now, you're paying 50 times earnings for bonds. So if I'm paying 25 times earnings for stocks, it looks like I'm getting a pretty decent bargain. So rather than complain about how expensive stocks look now to where they were 30 years ago, remember, that's not a choice. You can't put yourself in a time machine, go back and invest in the PE ratios of the 1990s. You have to look at what can I invest in right now? And I'll be quite honest, PE ratio to me is a metric for lazy investors. I know people read Ben Graham and say, Ben Graham was a fixed income guy. He wanted to buy a stock that looked like a bond. PE ratios were a metric designed to look at mature businesses with stable earnings. Find me one, especially after 2020. Can you find me a company with stable earnings? I look around the world, there isn't a single one. So why do we keep insisting on using a metric that doesn't fit most of the companies we're looking at? Somebody asked me, what's the PE ratio for Zomato? And I said, are you out of your mind? You take a young company, it's money losing. We can debate how much Zomato is worth. But to use PE ratio to judge a Tesla, Zomato, these young companies is absurd. It's like it's like bringing a cricket bat to a soccer game. What are you going to do with it? Wrong tool for the wrong place. So I think PE ratios are first. I think we need to stop the laziness in investing. We look at something like a PE ratio and say, that'll tell me what to do. A PE ratio is the start of your exploration of stocks. You have to look at growth. You got to look at risk. You got to look at cash flows. And you know what? After 2020, lazy investing is out of, it's out of form. You will not be able to get away with just looking at a single metric and making your judgments.
Right. So currently, when we've been talking about alternative investment bets as well, where would you see value and where would you see growth, taking into consideration the stock markets? You have your debt, which includes your bond as well. You have your money market, real estate. Where would you invest your money at this juncture?
I'll tell you the problem you have as an Indian investor is you're fenced off. No. You know where I bought what I bought last week? I bought Tencent. Why did I buy Tencent? Because I think after the Chinese government's punishment of the company, markets have knocked the price down enough for it to be a good investment for me.
Mm.
If you're willing to look for, if you are able to look for bargains worldwide, your choices proliferate. The problem for Indians is, I think in spite of the opening up of being able to invest a little bit outside, you are still stuck with Indian choices. There's a good reason why gold has been India's favorite long-term investment. Because if I don't let you pick something outside India, at some point, all stocks look expensive, all bonds look expensive, all real estate look expensive. What the heck are you going to do? You're going to do what millennia of Indians have done, which is take your money out of markets and buy something that you can see, that you think will hold its value. And in fact, one reason I think there's this zeal for cryptos among Indians is I've called it millennial gold for a very simple reason, which is if you're 30 or 35 years old and everything you look at looks expensive, you say, look, I'm going to put my money in something that's not connected to financial assets. Now I have my own issues with Bitcoin, but I can see why people are drawn to the cryptos when everything looks expensive. And it's not just in India, it's happening around the world. In fact, one reason you're seeing the rush into both cryptos and NFTs, people buying little clips of media and saying, what the heck are you doing? They're trying to buy something that they think will hold its value when financial assets collapse, and they're convinced that all financial assets are overpriced.
Right. So would you actually say that crypto or NFTs is something which is probably now an alternative investment bet that will pick up as well?
It's an alternative trading bet. It's not an investment bet because there are no cash flows. Just like gold, right? I'm not saying that in a bad way. I'm just saying it's a trading bet. You're buying it because you hope it'll hold its value. The problem, though, is collectibles are only as good as what people perceive them to be, not now, not next year, but 10 years from now, 20 years from now. The reason we trust gold is it's outlasted all of us. For thousands of years, gold has held its value. It's boring as heck, but it's something that's held its value. Bitcoin is 12 years old. In collectible time, that is like a blink in time. We don't know whether 15 years from now, Bitcoin will still hold its value. So that's why for the longest time, I've said, you know what, if you really want Bitcoin to hold its value, it's got to show me some substance, a currency that people actually use in transactions to buy stuff. And that's where Bitcoin has not done well. It's not done well because what makes it so attractive as a trade, that it can move a lot, be up 40% or down 40%, makes it a terrible currency. I mean, let's say you have 10 Bitcoin in your pocket and you went to buy a house. You'd think twice about using those 10 Bitcoin because you're afraid that if you use the Bitcoin today, it could go up 40% tomorrow and you could look at it and say, what did I do? So people don't want to spend it. On the other side of the transaction, people don't want to receive it, because they receive it and the price drops 40% tomorrow, you've sold your house at a 40% discount. What makes it such a good trade makes it a terrible investment, a terrible currency. So I think what needs to happen, if you're really a fan of cryptos, is we've got to stop talking about how much money we make on cryptos. We have to start actually making it into decent currencies that we can spend to buy things. I keep hearing people saying, well, overstock accepted. El Salvador today announced it's going. I'll believe it when I see it, because I've seen in the last 10 years, claim after claim about how somebody was going to accept Bitcoin, but then you look back and say, well, how much money did they actually receive? Overstock, which is one of the first companies to accept Bitcoin, got less than 1% of its revenues in Bitcoin. So it's one thing to say you're going to accept Bitcoin, but if nobody uses it, who really cares?
Absolutely. And with this, clearly, if you go to see in terms of where the markets go as well, what are the kind of risk factors that play currently according to you? Because clearly we are on a bull run. I mean, everyone's trying to gauge as to whether we are going in tandem with how the economy is functioning or not. Because with this, the way bond markets are functioning as well, you're seeing a disconnect between what's happening in the bond market and what's happening
Mhm.
in the stock market. So both of them are giving you different messages. So what are the risk factors at play, number one? And number two, do you think there is a possibility of a bubble that we are approaching?
That to me is the most troubling aspect of markets around the world, not just in India, is there's a disconnect, as you said, between the bond market and the stock market. Here's where the disconnect comes in. If you look at rates in the bond market, they're predicting slow growth and very low inflation. That's what the bond market is predicting. If you look at the stock market, it's predicting strong earnings growth, the recovery in the economy. And clearly, both markets cannot be right. And when you have markets moving in different directions, we've seen this happen before in the 1990s, in the middle of the last decade, 2005, 2006, 2007, then there's always a correction. That correction doesn't have to be catastrophic. 2008 was a catastrophic correction. I mean, I've lived in equity markets, which are long, I don't know what's worse, to actually have a 30% correction in 3 months or have a market that stays flat for a decade. A market that stays flat for a decade is really a downward market because you've put your money in equities, you've taken this risk and you make 2% a year. We've had lost decades before. So my worry is that we could set ourselves not so much for a massive correction, but for a period of miasma, nothing happens. Markets just stay stuck where they are. They go up, they go down. And if that happens over an extended period, it can be extraordinarily difficult to deal with as an investor.
So overall, currently, do you think the growth story in terms of India is intact?
India as an economy, as we have to separate because growth in India as an economy, growth in Indian company earnings, and growth in stock prices are three very different growth stories, right? The growth in stock price is a mood and momentum story. As long as there's a bigger fool out there willing to pay a higher price, the growth in stock price. Growth in earnings is a more tangible story. It's got to come from Indian companies making more money. But you know what? Indian companies can make more money while the Indian economy doesn't do that well. And we assume that everything is connected at the hip. I think the growth story for India is very much tied to the growth story for China right now.
Okay.
And here's the reason. Because China is, I think, entering a new chapter. I mean, you've seen this not just in the crackdown in tech companies. I wrote a post last week about the Chinese government, basically, that, I said, look, they can frame this however they want as being for the good of the people, that they're doing this to improve competition. But if you really believe that the Chinese government cares about either customers or competition, then you've been looking at a very different Chinese government than I have. This is a government that values control. And they're afraid that the way the economy is evolving is spinning out of their control. So what I think, as what you're seeing as actions, is essentially the Chinese government saying, we're in control. I don't care if you're, whoever you are. You could be Jack Ma, you could have started Alibaba and think you're the greatest person walking in the face of the earth. Now, we're going to show you who's boss around here. And effectively, what you're seeing is the Chinese government cracking down for control. The problem is, if you crack down for control, you give up growth. So one of the reasons the Chinese government has been able to grow is it's been willing to look the other direction. When Chinese tech companies go out and grow and they take actions that the Chinese government normally would not accept. So the Chinese government cracking down is, in a sense, good long-term for the India story because that growth is now going to leave a vacuum. Do you know that in between 2010 and 2019, 67% of global GDP growth came from China. Without China, the global economy would have been basically stuck on neutral for 10 years. Imagine taking China out of the equation, where China goes back, not even into recession, but it goes back to growing 2 or 3% a year, which I think is very possible. It's a very plausible story. The question is, who's going to step in? Now, is it guaranteed that India will? Absolutely not. This is like being in a very competitive marketplace where you got to come in and frame your story. And I think India has a chance to step into that void, but it's got to make the right moves. And for India, it's always been 3 steps forward, 2 steps back. I mean, and part of that is being a democracy. You cannot map out 10 steps forward as a democracy because it's not in your control. So one of the consequences of having legal pushback, of being a democracy, is things will move slower. But I think that if the Indian government can lay out at least broad principles that people can agree on, policies will obviously change. Then I think there's a chance for India to step into the void as a growth story. And I think some of that is being reflected in stock prices as well.
Right. So overall, right now, Ashwath, uh, how would you actually look at value or growth in the markets from your on? And which sectors, according to you, are ripe for disruption?
Now, I'll give you a very good indicator of sectors that are ripe for disruption.
Mm.
You have a big business, but nobody's happy. Customers are not happy. Companies are not happy. You're ripe for disruption. I'll give you two examples. In the US, if you're a bank, nobody's happy. Customers don't like the service they get from banks. Banks are convinced that the business is not a good business. The only reason Amazon hasn't disrupted the banking business is it does not want to deal with the regulation right now. It's a business ripe for disruption. And guess what's happening? Fintech is rising and taking away all the easy business. I'll give you another example of a business where nobody's happy. The education business in the US. Universities charge outlandish tuitions. Students are not happy. Faculty are not happy. Administration is not happy. When you have a big business where nobody is happy, you're begging for disruption. What I would suggest to Indians is look around you at businesses where everybody's unhappy. Customers are unhappy, businesses are unhappy. That business is ripe for disruption. I mean, I think retail collectively in India is ripe for disruption. Nobody's happy. I mean, the whole business looks like it's broken. It's become a real estate play where nobody makes money. So is it a surprise that Flipkart and Amazon are eating retailers' lunch? Not at all. So I think that retail in India is ripe for disruption. Banks in India are well beyond ripe for disruption. I mean, this business is badly managed, badly run. It is almost catastrophically run. And the problem when you have a banking business that's badly run, it can bring the economy down. So I think financial services in India is right. So I'm not surprised that Paytm, as it's getting ready for its IPO, is everybody's looking to say maybe this is the disruptor. There will be a lot of false prophets before you get the final one. But that's, I would say that look for big businesses where nobody's happy, and those businesses are going to be the next ones on the target for disruption.
Right. So when you right now, I mean, these are interesting examples that you've given us right now. With this, one question I want to ask you is, lately, we've always seen there's a flurry of IPOs which come in, and the kind of valuations they demand. Again, I understand everyone just looks at the price to earnings. However, the initial gains that we see when they list is mind-boggling.
So my question is, why do we have bankers? I've never understood, why do you pay bankers? I mean, you could just, I've never understood this notion that bankers somehow bring something to the IPO process of value. You know what? Zomato could have gone public without a single banker involved. They'd probably have got the same price and not have to leave money on the table that they did.
Correct.
So it's true, but they're not demanding the price. You know who's setting the price? It's driven by investors. So much as we'd like to think Zomato wanted 120 rupees per share, they'd have been happy with 75. It's 120 was set by people coming in the market saying, I want to pay 120. I have zero sympathy for people who buy shares on IPOs and lose 30%.
Correct.
Now, if you want to be greedy and play the game, but don't come complaining to me that companies misled you. In fact, Zomato's prospectus is completely transparent in the fact that it makes no money. It might never make money. It might not make it through the next 3 years. It tells you everything. In fact, it's like confessional. They confess to every conceivable sin on the face of the earth because they know that the people who will buy their shares don't really even read the prospectus or care what's in it.
Correct.
The reality is, people are greedy. And that's, I'm not saying that is a bad thing. Investing has always been driven, or trading at least has been driven by greed. Where you say, look, I don't care what Zomato is worth. In fact, they're very open about the fact. They say, look, I'm going to buy it at 120. You know why? Because I can sell it to somebody else at 140. I'm going to buy it at 140 because it's sell it. This is the nature of trading. It's in a sense a much more honest game than investing. There's no intellectual artifact that you stand behind. You just say, look, I trade because I can make money. So when I see IPOs trading at well above list price, I'm not going to look at those people as being somehow dummies who are taken to the cleaners. They're playing a game. They're doing the same thing they'd have done if they walked into a casino. And if they make money, I'm going to congratulate them on making money. But if they lose money, I'm saying, don't come back here and complain about other people as if you were forced to buy these shares. We know what, we've got to allow investors to make their own mistakes. If we keep protecting them from their own mistakes, we're just encouraging more greed in the future.
Absolutely. I mean, this is a very well-made point right now, because lately that's become a trend right now with investors. My very last question coming to you is, what is the kind of outlook do you have with regards to India? We've already spoken about it, but from the perspective of what Fed has said in terms of their recent commentary, what do you make of the tapering that we're looking at? Because you've always called the Fed like the Wizard of Oz. So do you think that's something which can have a major impact on how emerging markets like in India would actually perform?
I think we're all globally connected at the hip. If nothing else, that's what we've learned since 2008. So I'll tell you, what happens in India is going to be very closely related to what happens in the US, what happens in Europe, what happens in the rest of the world. There'll be periods of disconnect, but I think we share more in common. I think that, as I said earlier, there's a clash coming between what the bond market believes about the future and what the stock market believes in the future. And if the Fed is smart, it'll get ahead of the game. What that means is they know that rates are going to go up because the bond market, they'll have to act like they see it coming and they're the ones driving it. That's why I've described it as a Wizard of Oz. They've got to get ahead of the game and make it look like they're the ones driving the game. When in fact, they're just passengers on this train. So I think whether the Fed tapers or not is out of their control. T-bond rates are going to go up with or without the Fed if the economy comes back strongly and inflation comes back. Nothing the Fed can do to stop it. This notion that the Fed can somehow stop rates from rising is absurd. But I think it's held by people because it makes them feel more comfortable. They think the Fed can keep rates low while they do whatever they want with stocks. It allows them to do stupid things and use the Fed as justification. So I would not trust the Fed to be your savior here, because if you are, then you're asking for trouble.
Absolutely. I think I really like your anecdotes and the way you've connected it. Thank you, Aswath, so much for joining us on the show. A pleasure to speak to you, get insights. Happy to speak to you soon again. And do visit us whenever you're in Bombay.
I will. Thank you.
Thank you and stay safe.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.